Hello, welcome to this week's Your Money Matters. We're continuing our theme of Confessions of a Traditional Financial Planner. We've got the sub-series going on, and we're talking about different ways of actually doing things alternatively. And we're going to hit on saving money this week. So, when people start out saving money, some will use bank accounts, which can be a good way to build emergency funds. Others are going to start putting their money straight into 401k plans and other investments that are inside of a qualified plan. A qualified plan is those retirement plans that you have at work or an IRA. Now, here's the problems and pitfalls with these strategies. Banks are currently paying much less than 1%, and it's taxable every year. Bank accounts are not necessarily private or secure. You've got threats of civil asset forfeiture, cyber crimes, identity theft, liens, lawsuits, garnishments. There's countless examples of how someone's bank savings has ended up in someone else's hands. Qualified plans make poor saving vehicles. They subject your money to risk. They put it behind a tax wall. They tie up dollars where they cannot be used. Okay, the fees are high. Money can be, you can borrow money from a bank, but only if you qualify for the loan. And the rules for borrowing, if you have a 401k, are strict and for limited reasons. Investment options are also limited inside of qualified plans. Typically, your choices are to take risks with securities or park your money in cash equivalent, earning next to nothing. Regardless of whether a person saves in a qualified plan or savings account, if they desire life insurance, they're going to have to pay additionally for some form of term policy that will expire after a certain period of time. Term insurance premiums must be counted. We count them as an opportunity cost. And so that means that that's money that you're spending there that you cannot invest or save elsewhere. Nor with a term policy is your family likely to receive any death benefit. Less than 2% of term life policies actually end up paying off on a death claim. When we talk about our alternative retirement strategies, one of the solutions that we have is to save in a high cash value, properly structured properly structured high cash value permanent life insurance policy. And we say properly structured because you're trying to put the most money in that you can to buy the least amount of life insurance. It's not necessarily an efficient way to buy the most life insurance, but it's a phenomenal savings tool. Okay, and we say save and not invest, and that's because insurance is not classified as an investment. It's more appropriate to compare a properly structured and properly funded permanent cash value life insurance policy to a safe liquid investment that cannot lose value. Lehowever, there's really no comparison because when you use this strategy, when you hold it for a long period of time, typically more than at least 10 years, rates of returns are averaging somewhere between 5, 6, 7, 8%. And then that will depend on your age and your health. You'll have greater returns, and you'll have more privacy and more security than the banks provide, and there's still that no downside risk. The cash value is liquid. You can borrow against it for any time, for any reason. It can also be withdrawn, but we don't recommend withdrawals in situations. You can create some taxable situations in that if you do it incorrectly. The cash value kind of becomes an all-purpose savings, kind of maybe like a Swiss Army knife. It can be used for multiple purposes, maybe a home repair, college tuition, a rental property, down payment, healthcare costs, business expenses, new cars, and the list goes on. Being able to save in one large account instead of many other little smaller single purpose accounts means that you can build more liquidity and more financial flexibility. When you borrow the money from your policy, the policy loans can be repaid on your schedule, while the cash value is used as collateral. It keeps growing. It's unaffected by the loan. That's amazing that it can do that. Permanent insurance increases your estate value, and it creates legacies for your heirs and charities. The death benefit grows with a permanent life policy and provides additional value to the estate. One of the things you can do is, if you structure it properly, it gives you permission to spend down your other assets, okay, because you're not worried about running out of money, and you still leave something behind to your as a legacy. In certain situations, death benefits can also be used by you, the policyholder, while you're still living. See, Policies can be sold on the secondary insurance market, or they have living benefits where we can accelerate the death benefits according to different riders in cases of maybe a terminal illness or chronic illness or a critical illness, long-term care type situation. An adequately funded permanent life insurance policy. You can also look at a waiver of premium rider for potentially almost eliminate the need for disability insurance or even term life insurance. In many states, permanent life cash value accounts are protected from liens and lawsuits, and in all states, it's protected from the prying eyes of the IRS. Life insurance policy cash value is not counted as an asset for college. That is for public schools. It is for private schools, and nor are policy loans. The policy loans are not considered income by the IRS. So, typical financial advice speaks of savings in terms of emergency funds, and yes, emergency funds are very important. They're so important that if you don't have liquid funds to sustain you for a number of months, that you should save that first and obtain maybe term insurance needed or desired before you start a permanent life policy. Saving money is just the foundation. It's the first step of putting yourself in a position where you can put that money to work through other alternative strategies. And savings isn't just for emergencies, it's also for opportunities. You know, we've talked about the velocity of money through this series, and one of the secrets that makes alternative retirement strategies so effective is that these opportunities are where wealth building can really start to accelerate and multiply. Too often people have their savings and investments tied up in 15 different places where money is inaccessible. An IRA or two, a 401k, a 529 for each child, and so on. They don't even see the opportunities because they have no liquidity to take advantage of them. They have no way to access that money. So when people build up their savings and liquidity, they have the ability to invest significant sums of money, and new opportunities start suddenly coming their way. So this is it's a different way of looking at things, folks. We're really focusing more on one big type thing that serves so many different purposes for us throughout our lives in probably the most efficient, safe manner possible. I certainly haven't found anything else that's safer or more efficient in order to do this. Think about it. When you can borrow money against your policy without it, so if you had $100,000 in cash value and you pulled $20,000 out, if you were in the bank, would you earn interest on $100,000 or on $80,000? If you're in the bank, you'd earn interest on 80, right? Well, in this, you still earn on 100. And if you structure it properly, okay, you can also, when the policy is actually pays earns a return, then you can actually have the interest paid for you on that $20,000 and pay you maybe even more if the amount that you earned was higher than the interest rate that the insurance company charged you. So it's some really amazing things. When I first read about these 12, 13 years ago now, I got that. Sounds too good to be true. And most of the time when you hear that or feel that's the case, it is too good to be true. But I continue to research. I researched from several different sources. I've verified through several different sources that you can, in fact, do all these things with this. So it may sound like it's too good to be true, but it's not. It's true. This is real. Is it perfect? No, nothing's perfect. But if you have the patience and you follow up and can follow a plan, okay, and I say patience, it takes about 10 years for this to really kick in. You've still got, there's liquidity along the way, but for this thing to really start returning, making it really look good, you need to go out 10 years or more, which is fine for most of us because most of us have more than 10 years that we're going to need the money for retirement. One of the biggest things it does is it gives you a pool of money that's available if you need long-term care. Okay? So it's not called long-term care insurance. It's not supposed to compete with long-term care insurance. I can't say that it does. I will say this, though. If you have a pool of money that will appear when you need it if you need long-term care, will that help you pay for long-term care? It will, won't it, right? Well, that's what this does. And if you don't use it, you don't lose it. It passes to your heirs tax-free according to current tax law. So now remember, I'm not a tax advisor. Always consult your tax advisor. If you have one that contradicts what I say, put them in contact with me, and I can discuss it with them, because what I'm finding is a lot of tax people don't really understand this. They've written it off. They believe the smear campaign, so to speak, that has gone on against properly structured permanent life insurance for years. And in my opinion, it's through the jealousy of Wall Street and the banks and everyone else. They really don't want you to know about it, because they know that if you did know about it, you wouldn't be putting as much money or any money with them. So that definitely would hurt their pocketbook. So I hope you're enjoying this series on Confessions from a Traditional Financial Planner. These are things that I've thought for a long period of time, and it's nice to find other financial professionals that kind of see almost eye to eye with me. So this is not what I'm saying. This is what a lady by the name of Kim Butler has said in a nice ebook that I had downloaded, and I'm just kind of going through what she says. Just happens to go along with most of what I teach clients. So have a great day. Hope you have a great week. And if you have any questions, my contact information is there on the screen. Would love to answer any questions or try to help you out with anything that I can. And also, if you found value in these, please share the links with your friends, family, coworkers, anybody you care about that you think might want to keep their money safe and have it efficient and tax efficient and multiply, do all kinds of different things. Have them tune in and start watching some of these, or contact me directly and I can discuss what I can do for them personally. Hope you have a great day. Talk to you soon.